Hi all, and welcome to the second part of my second lecture related to Bitcoin education. In this lecture, we will deep dive on capital market accumulation. As always, fundamental rules. The aim of the presentation is to share the knowledge and is not a financial advice. Every individual is fully responsible of how he decides to invest his money. And investing is risky. You can lose all your capital. A reference book is the Bitcoin Standard, the best book to read in order to understand the Bitcoin revolution. Let's start with the capital market. And according to Hayek, Austrian economist, discussing about the problem of allocating resources and products, is saying that contrary to popular elementary treatments of the topic, the economic problem is not merely the problem of allocating resources and products, but more accurately, the problem of allocating them using knowledge that is not given in its totality to any single individual or entity. Economic knowledge of the condition of the production, the relative availability and abundance of the factor of production is not objective knowledge that can be fully known to a single entity. The knowledge is by nature distributed and situated with the people concerned by their individual decision. So, and in free market economic system, price are the knowledge and the signals to communicate information. So he's saying it's not the problem that a person very knowledgeable is picking the right price or not, or allocating the right supply demand, a right amount of resources to any product or service, but is that by nature um, knowledge is distributed. Therefore, a single person or a single group will never be able to say to establish the right price or the right amount of resources to allocate. And in a an example was the earthquake in Chile, where Chile were a lot of mines of copper, and in there was a in one day there was less supply available because of this earthquake, and the price went up 6.2% in price of copper. This was the signal of producing more and buying less, and within few days the price was back to normal. No matter the knowledge of a central entity, will never know which will be the right price and the right amount of supply and demand. Let's go on with socialism that is also saying that socialism must fail not because of the known incentive problem, but it will fail at the economic calculation. But the most crucially in the allocation of capital goods. The supply and demand of capital goods emerge from the interaction between producers and consumers and their iterative decisions. In a socialist economy, government owns and controls the means of production, making a sound decision on prices impossible. While in modern economy, capital market consists of the market of loanable funds. And this is where the capital market is the loanable fund. And high interest rates are good for the lender, but not good for the borrower. Generally, a society with a lot of individuals with low time preference is likely to have plenty of savings, bringing the interest rates down and providing for plenty of capital for firms to invest, generating significant economic growth for the future. The more the people have lower time preference, the more they save for the future, the more they have money available. This money available will be given to investors that will use to improve productivity and to improve the production, so to go on with the civilization and for economic flourishing. Another topic, fractional reserve banking system. How the banks are working now with not in a free market but in a market we are living now. So the banks create money whenever they engage in lending. In a fractional reserve banking system, banks not only lends the savings of their customer but also their demand deposit. By giving the money to the borrower while keeping it available to the depositors, the bank effectively creates new money, and that results in increasing in money supply. This underlines the relationship between money supply and interest rates. When interest rates drop, there is an increase in lending, which leads to an increase of money creation and a further rise of money supply. On the other hand, a rise in interest rates causes a reduction in lending and then a contraction in the money supply, or at least a reduction in the rate of its growth of money supply. Let's analyze now the business cycle in a financial crisis. Let's discuss about the loans in a free market. How we will be in a free market. In a free market economy, the exact amount of savings becomes the exact amount of loanable fund available for the producer to borrow. But this money will not be available for the depositor to use. So the availability of capital goods is inextricably linked to the reduction of consumption. So someone who want to borrow money, there should be someone who put this money in the bank and is agreeing in not touching this money. So delaying gratification and not using this money to consume. And the availability of capital goods, actual physical resources, labor and land and capital goods will move from being employed in the provision of final consumption good to the production of capital goods. So with this money will not be used to consume, but will use to improve production. In fact, the marginal worker is directed away from car sales and towards a job in the car factory. Central banks um, manage money supply and interest rates, and they generally try to spur economic growth and investment and to increase consumption. So they tend to increase money supply and lower the interest rate, resulting in a larger quantity on a loanable fund than savings. So generally, central banks are always in favor to economic growth, so to spending. That's why they are making the interest rate lower, and they always encourage people to borrow money. So business take on more debts to start the project, and savers put aside to finance this investment. Without enough consumption deferred, there will be not enough capital, land and labor resources diverted away from consumption goods towards higher order capital goods at the earliest stage of production. And in fact, there will be the common sentence is there is no free lunch, and if consumers save less, there will be less capital for investors because increasing money is not increasing the capital remain the same. And if the consumer save less, there will be less capital for the investors. In fact, creating what we learn here, that creating new piece of paper doesn't magically increase the society physical capital stocks. It only devalues the existing money supply and distort the price. In fact, the shortage of capital is not immediate. What happened is the shortage of capital is not immediately apparent. And the excess of money initially makes more producers borrow. So everyone has more money, and the producer operating under the delusion that the money will allow them to buy the capital goods necessary for the production process. As more and what happened then in the middle term, as more and more producers are bidding for fewer capital goods and resources, because the capital available is fixed, is not increased by increasing money, but the money there are more, so there are more and more producers for fewer capital goods and resources than they expect to be. The natural outcome is a rise on the price of the capital good during the production process. So after 1 year, the price increase. After 2 years, increase more. 3, 4, and 5, and so on. This is the point at which the manipulation is exposed, lending to the simultaneous collapse of several capital investments, which suddenly become unprofitable at the new capital good price. These projects are called malinvestments, investment that would not have undertaken without the distortion of the capital market, whose completion is not possible once the misallocation are exposed. So this became malinvestment just because they should not have been taken place in the first place because there were too many projects available, too much money available with a fixed amount of capital goods. And now the distortion of a central bank. So a central bank intervention allows for more projects to be undertaken, but cannot increase the amount of actual capital available. So these projects are not completed and become unnecessary waste of capital. The suspension of this project caused a rise in unemployment. In fact, the economy-wide simultaneous failure of overextended business is what is referred as recession. The business cycle is the natural result of the manipulation of the interest rate, distorting the market for capital by making investors imagine they can attain more capital than is available. The reason, in fact, that price control must fail is not the central bank cannot pick the right price, but rather than by merely imposing a price, any price, they prevent the market process from allowing prices to coordinate consumption and production decision among market participants, resulting in an inevitable shortages or surpluses. So it's not that they are picking the right price. They cannot pick. They are not. They are not good enough to pick the right price. But a single entity will never be able to pick the right price. This I wrote it everything because it's a very interesting and but also complex topic. So in fact, increasing money supply was the biggest cause of every U.S. recession. For example, in 1921 to 1929, before the biggest recessions, the money supply increased by 68.1%, while the gold stock expanded by 15%. Let's deep dive a bit here. In fact, as soon as the expansion slowed down, the expansion of money supply, they create a bubble that was inevitably going to burst. Then deflation comes and wealth disappear, and banks struggle to meet their obligation. This exposed the problem of having fractional reserve banking system. It is a disaster waiting to happen. It would have been better for Fed to have guaranteed only deposited and not business or stock as they did during the recession. Allowing liquidation to take place and price to fail is the only solution. It is true that this solution would have involved a painful recession, but this is exactly why the monetary expansion should not have happened in the first place. And last but not least, and very important, attempting to avert a recession by pouring more liquidity into it will only exacerbate the distortion, which caused the crisis in the first place. So they increase the money supply, they create a bubble, this bubble explode, and how they try um, to solve this? Putting more money supply. So this is just exacerbating the situation. And the increase of money supply should not have happened in the first place. And also learning from the history, we see that there is nothing inherent about the working of a market economy that will create a persistent problem of unemployment. In fact, with free market, many people will lose or quit jobs, and many business will go bankrupt, the not profitable business. But these job losses will roughly cancelled out with newly created jobs and business. Only when a central bank manipulates the money supply and interest rates, it becomes possible for large-scale failure across the entire sectors of the economy to happen in the same time. Last but not least, what we have learned from this lecture, considering also time preference. Firstly, time preference is influenced by the future value of money. Secondly, the lower an individual time preference, the more likely is to engage in investment and accumulate capital. Third, civilization is about what capital accumulation allows human to achieve and is not about spending. And then biggest Keynesian misunderstanding, and this we will deep dive in the third lecture, that is delaying current consumption by saving will put workers out of work and cause economic production to stall. In fact, on contrary, we have seen that in the history, whenever we have a sound money that increase value over time, economy is flourishing. And then creating more piece of papers, no increase society's physical capital stocks, but is devalues the existing money supply and distort the price. And increasing money supply was the biggest cause of every US recessions. These are the the lesson learned from this lecture. I hope you learned something and see you in the next video. Bye.